It's never before in history where we'll basically watch in real time over the next 2 or 3 decades, these major economies lose 20% of their prime age population. It's going to be just an absolutely unbelievable collapse in demand for goods in those economies. And it is unclear how those countries are planning to handle that situation.
Is the stock market disconnected from economic reality, or is it more or less in line with actual growth? We'll here to talk about what's been happening and what's next with our next guest, Eric Basmajian. He is the founder of EPB Research, and we'll be talking about equities, the real estate market, his economic outlook, and whether or not a recession is imminent. Eric, welcome to the David Lynn Report. Good to see you.
Good to see you, David. Congratulations on the new show.
Thank you. And congratulations on your work and your YouTube channel. I'll put a link in the description down below. Everybody should check out Eric's YouTube channel. That's been blowing up for good reason. You've got a lot of good videos and good content out there, so I encourage everyone to check that out. Let's talk about a few of your recent research videos that you've put out. In particular, you've been talking about how interest rates usually when a Fed pauses, or usually when a Fed stops raising rates or perhaps pivots, it's not entirely positive for equity markets right away. Is that true?
Yeah, usually that is the case, because what usually forces the Fed to pause or to pivot is usually some underlying stress in the economy, in the banking sector, in the labor market, or just broader financial markets. So the reason for them pausing is usually not a bullish sign. And when you experience what's called credit stress in the economy, that's not usually something that the Fed can fix just by a series of quick rate cuts. And in my view, we're at the beginnings of what looks like credit stress in the underlying economy that started with some of the banking issues a couple of months ago. So when times are good and when the economy is not near recessionary conditions, pauses in monetary policy or easings in monetary policy bring pretty quick and forceful equity market and asset market rallies. But when the economy is in recession or experiencing credit conditions, usually forceful monetary easing is not sufficient to drive asset prices higher. The best and most recent example of that would be around the 2008 recession. The Fed started easing monetary policy towards the end of 2007 and all throughout 2008. And because there was such severe underlying credit stress, 4 or 5 percentage point rate cuts was not enough to prevent the equity market from going down and the real estate market from going down. So it's not a one factor model that we're dealing with here, where rate cuts mean assets up. It's a little bit more complicated than that when we get towards recessionary periods.
Do you think that's what the Federal Reserve is doing right now? In the last FOMC meeting, when they kept rates unchanged, that's the most objective way to put it. They kept rates unchanged. If you want to be a little more dramatic, you can say they skipped. That's actually the word Fed Chair Jerome Powell used inadvertently, and then he quickly corrected himself. So we're going to come back to the credit crunch that you mentioned in just a bit. But going back to my question, why do you think they paused?
Yeah, a little bit of a Freudian slip for Powell, right? So I think that is the reason why they paused or skipped, is because they do see the underlying stresses in the economy, and they also are aware that their policy acts with long lags. I don't think they're as aware as they should be of just how long some of those lags could be, but they are seeing the stresses, particularly in the banking sector, because all of the FOMC board members have contacts with banks in their specific regions. And banks are clearly reporting to their Federal Reserve contacts that they're feeling very significant funding stress from the interest rate rises already, as well as the assets that they're holding on their books that are severely underwater. So further increases in interest rates, the Fed officials know, will make the banking problem worse. Because one of the problems that the banks are experiencing is they're holding a lot of assets that are underwater. And if the Fed increases interest rates even more, it'll put those assets even further underwater, increasing the fragility of the banking sector. So I think the banking issue, which is ultimately the beginnings of a credit contraction, is what's worrying the Fed. And the speed at which that process evolves, I think, will dictate whether they increase rates further from here. I think that it would be a mistake for them to increase interest rates further from here, because keeping rates the same will still add a lot of pressure to the economy, given how high and how quickly they've already moved.
A credit contraction for whom, though, is the question. Is it credit contraction impacting the larger corporations? Is it small businesses? Is it the everyday consumer? Who's going to be most impacted?
Yeah, that's a great question. And the way that I like to explain this is it's sort of like an onion, where you have the core is the biggest and most liquid corporations. Think about your S&P 500 corporations. Those companies are at the core of the system. And it's very, very unlikely that those companies lose access to credit unless you're in the middle of a very significant event like COVID or the depths of the 2008 crisis, when the entire financial market completely freezes. And because we've become such a equity-centric culture, everybody is pretty much just staring at the S&P 500, we tend to miss all of the contractions in credit that happen towards more of what I would call the periphery of the economy versus the core. If the core of the economy is your big liquid S&P 500 companies, every layer removed you get becomes a little bit more difficult to access credit, where if you're all the way on the periphery, you may think of an unsecured creditor for a business that doesn't have any collateral. Those businesses clearly are already being shut out of new capital. You think about commercial real estate. If you're a multifamily residential building, that's a little bit closer to the core. You may be able to get financing. It's getting a little bit more difficult. But if you're a more risky commercial real estate loan, perhaps you're in the solar economy, parts of the economy that are a little bit more esoteric, that aren't as big and liquid and common, those parts of the economy lose access to credit much more quickly. And we've already seen that pretty significantly. So you think about subprime auto, for example, that market is basically completely shut to new credit. So these contractions in credit always start on the periphery and they move closer and closer to the core. The problem is by the time they get to the core, it's usually a full-fledged financial market seizure. So I think it's important for the Fed to realize the contractions in credit that are happening on the periphery, and they're starting to become aware of that because it's fallen in their lap in the form of the regional banking crisis. But I don't think they're as worried about how significant the contraction is in parts of the economy already.
On that point, so yes, you're right. There are contractions in credit, perhaps shrinking in credit facilities available, but the availability of credit is one issue. Is there a demand for credit is another issue. Right now, like I was just talking to you offline about this, and I'm speaking on behalf of myself, a consumer, not on behalf of a corporation or a large entity. I want to put off on borrowing and getting credit for a car or another mortgage, for example, because I know interest rates are high right now. And I know that if the Fed pauses, it's not going to go much higher. Perhaps one or two more people are telling me, but eventually the interest rates will have to roll over as we enter a recession. I would rather just wait until interest rates come down. And so even though credit is crunched or shrinking, is there a demand for credit?
Well, there is a demand for credit at a certain level of interest rates. It's the same supply and demand curve as any equation that you may deal with, where for a given price or a given level of supply of credit, there's a demand for credit. So everyone says there's a lot of demand for credit, and that may be true if interest rates were 3%. Sure, there'd be a line of people around the door looking for credit. But interest rates are not 3%. So the demand for credit is not there at the terms that the banks are willing to loan at, because they're worried about their portfolios. They're worried about their businesses. So they're only willing to extend credit at certain terms. those terms are obviously significantly tighter than they were a year or 2 years ago. And that means the demand for credit at these interest rates is quite low. So the longer that they keep interest rates at this level, the less transactions we're going to see. And then the more the broader economy is going to eventually slow. If they don't keep, for example, if they keep interest rates at this level for another year and you forego buying that vehicle for another year, that's going to impact the production levels of auto manufacturers. That's going to impact the employment levels of auto manufacturers, because you're making the decision and there are probably a million other people that are making the same decision. So if they lowered interest rates today, there may be a million purchases of cars of people like yourself. But if they keep interest rates high, that's a million less sales that they're going to get. And their order books are already very low because interest rates have been high and people have been foregoing these purchases. So that is the way that the economy spirals. So they have sufficiently engineered a level of credit contraction that's preventing people from making purchases. I, in fact, think they've probably raised them too high. The question now is going to be how long they hold them there, because that is going to start to leak through to employment and other conditions.
Let's talk about that. Good segue to the Fed monetary policy. So yeah, my decision to hold off on, let's say, buying a car is predicated on the assumption that rates will go down. Whether or not that assumption is correct, let's discuss that right now. Where interest rates headed from here?
Okay, so I want to make the distinction here, because there is a difference that, again, when we're in a non-recessionary period, the Fed funds rate, or the interest rates that the Fed controls, tend to be very correlated to mortgage rates and auto loan rates and interest rates broadly in the economy, because what's called the spread, or the difference between the Fed funds rate and, let's say, the auto loan rate, is generally pretty tight and constant. However, when we go into these recessionary periods, that spread, which is the sort of the safety for the person who's making the loan, those spreads tend to widen out. So I think that the first step that's going to occur is when the Fed sees more labor market stress or more financial market stress, which I think will be before the end of the year, they're likely to reverse their policy and start to discuss lowering interest rates. Now, that's going to put downward pressure on the Fed funds and Treasury rates, but that may not cause the private borrowing rates to follow down as well, because that spread is going to rise. So if an auto dealer is used to lending at 3% above the Fed funds rate, they may want to increase that spread to 5% above the Fed funds rate. So even if the Fed lowers interest rates by 2%, you may still have the same auto rate for a period of time. Now, that doesn't last permanently. That only lasts temporarily while the economy is in a period of uncertainty and in the middle of a recessionary period. Ultimately, those spreads come down and they will track the Treasury rates. But I think that the Treasury rates themselves will move down first, and the private rates will follow a little bit longer after that. That's usually what happens if the economy does move into a recession. I always go back to the 2007, 2008 example, not to try and draw an analog to the severity, but just trying to draw an analog to the process. Again, the Fed funds rate was 5% in 2007, and it was 0% in 2008. But in 2008, there weren't a lot of people that were willing to give you a mortgage. So despite the fact that the interest rates came down so much, there still was a very significant freeze on private credit.
I've been looking at data from the St. Louis Fed. The delinquency rate on credit card loans, I'm talking about consumer credit again, that's been rising steadily. In fact, it's been rising at the fastest pace since 2008. It's currently at 2.4% for the latest quarter. It was at only 1.5% 2 years ago in Q3 2021. At the peak, the delinquency rate was near 7% in 2009. But we know the reasons for that. So it's still nowhere near the last great financial crisis in terms of people defaulting on their loans, but it is rising. And It's rising at an alarming pace. Does this stat have any significance when it comes to either consumer appetite for credit or how the banks will react or the balance sheet of the banks? How are you reading the stat?
It does. You do good research, David. That's a good point that you make. And what I would notice is the stat that you rattled off was it hit its high in 2009. That speaks to where that data point falls in the economic sequence. So that would be what we would consider a lagging economic indicator because the peak in the data point occurred as the recession was ending or as it was over. So what I want to quickly define for everybody is the process that I use whenever I look at economic data or statistics that are coming in. I always parse them or sequence them in terms of the order in which they occur. So in my framework, I track what's called the leading economy, the cyclical economy, the broader or total economy, and then you have the lagging economy. So whenever a data point comes in, you can quickly tell, is this a leading data point? Is this a lagging data point? So you make a really good point about the delinquencies rising, but considering the fact that we know that that's a lagging indicator, that means that there's already been a significant amount of stress that's occurred in the leading economy for it to have already made its way to the consumer. So the fact that the consumer is starting to experience credit stress and rising delinquency rates means that they've already pulled a lot of levers to prevent that from occurring. And this is sort of a last ditch thing that occurs. You may think about selling your home before you default on debt. You may think about selling a car before you default on debt. You may cut back your spending on other areas, which we've already seen. And once you've sort of exhausted all of your options, then you'll default on the debt because there are impacts to doing that. So it is a significant data point to me, and it's one that confirms that the economy is already experiencing credit stress, considering that that's usually one of the last things to start to move. And concerningly, none of the things that we would look at in the leading economy would tell us that upward trajectory is going to slow down. In fact, all of the leading metrics are still quite negative, which tell us that we should, in fact, be ready for those delinquency rates to continue on their upward trajectory.
So what other leading indicators are you looking at, Eric, besides credit?
Okay, so when we look at our sort of four buckets that I defined, our leading economy, our cyclical economy, total, and then lagging, our leading economy is generally composed of monetary and credit variables, a lot of which we started to discuss. So given the fact that the Federal Reserve is still tightening monetary policy, the yield curve is still inverted, those very, very leading parts of the economy tell us that the rest of the sequence is going to continue moving lower. So then we move over to what we would call our cyclical economy, which is comprised of mostly construction and manufacturing, because those industries move slightly after the Fed makes a policy decision, but they're so sensitive to changes in interest rates and availability of credit that they usually feel the effects before a service-oriented business, which would fall in the total economy. So we have our leading economy, which is made up of monetary variables and how easy it is to access credit. Then we have our cyclical economy of construction and manufacturing. Then we have our total economy, which includes everything like our services. And then we have our lagging economy, which is mostly the stuff that the Fed looks at, like employment, wages, and things like that. So when we kind of rattle through that sequence, we can get an idea of where the rest of the process is going. All of the very leading variables, as I mentioned, are still deeply in contraction and not getting any better, which is concerning. Our cyclical economy of construction and manufacturing is slowing down quite aggressively. We still have a lot of construction that's going on in the South, building a lot of apartment buildings, But excluding that, we're seeing very significant weakness in the rest of the country for construction, specifically residential construction. And then we're seeing even more stress in the manufacturing sector. So the impact of the monetary policy that's already occurred has occurred in the leading economy, and it's occurred in the cyclical economy. Now we're starting to see the early signs of it leak through the broader economy with our initial jobless claims that are starting to rise. Your real retail sales are contracting. Those are things that are more broad aggregate economic indicators that are already feeling this stress. It's the lagging stuff that still looks pretty good, like high levels of inflation, and good, I mean high levels. So high levels of inflation and low unemployment. But those things will move after the earlier parts of the sequence. And when we look at that whole process, there's really nothing in the first two steps that tell us things are going to get better. We're still going to head on this downward trajectory.
Okay, I want to come back to the real estate because you've done a lot of good work on analyzing real estate, but I'll come back to that later. I want to finish off on the economy and talk about equities next. Now, as a researcher, you of all people understand that there's various ways to interpret data. So you brought up a lot of key metrics. So retail sales, for example, rolling over. How could you interpret that data rolling over? So there's a few ways we can interpret that. One, yes, retail sales are slowing down because people have less money to spend. Two, it's been slowing down because inflation's been coming down, and so it's not that the volume of goods is gone down. It's because the prices on an aggregate level have come down because inflation's come down. Or number three, it's because we've seen such a boom during the pandemic or post-pandemic when everyone had free money to spend that eventually it was going to roll over anyway. It's not because it's a bad thing. It's just because of the base effect. And so it's just normalizing. So how would you interpret this?
Okay, so what I would say is that, firstly, I'm looking at the level of retail sales adjusted for inflation because I am trying to capture that volume. I think it's very important that we do want to capture that volume. The second thing is that the reason that retail sales, which is very concentrated in durable goods, as you mentioned, the reason that that's so important is because it has what's called a high multiplier effect. So even if retail sales in terms of volume are slowing for what appears to be benign reasons, it's still going to have a ripple effect through the broader economy. For example, if we ordered a lot of washing machines and outside patio furniture and office equipment because of the pandemic or because people had a lot of extra money, that kicks into place a manufacturing process of people that have to produce those goods. That puts in place a very significant global transportation process of moving those goods from the manufacturing facility onto ships, onto planes, onto trucks, and then to the retail store, and then eventually to the end consumer. So even if the level of retail sales, the volume of retail sales slows for no particular reason other than we artificially stimulated it, then that also means we artificially stimulated the manufacturing sector, the transportation sector, and everything that came as a result of that boom. So when we see the volume of real retail sales slow down and not recover, that tells us with a really high degree of confidence that the manufacturing sector is going to slow down, the employment in the manufacturing sector is going to slow down, and then the transportation sector is going to slow down. And we have really good evidence of that. So the fact that we're seeing 42 on manufacturing PMIs is not unrelated to the decline in the volume of retail sales. And the fact that we're seeing declines in trucking, and if you're familiar with the folks over at FreightWaves who do really good news on the global transportation sector, they're posting a lot of articles from trucking companies that are saying this is worse than 2008. Because the volume of these goods has fallen so much from these artificial levels that they all had to overstaff to meet the demand to push all of those goods out. And now the volume's coming down and they're stuck with all of these people, which eventually they're going to have to get rid of, which will push the process forward.
Let's talk about a recession then. Good segue again. I'm looking at this chart from the New York Fed. Now, they published their probability of a U.S. recession, and they update this regularly. It's predicted by the Treasury spread. And right now, that probability is 70.8%. It's the highest since 1982. It is much higher than their probability in even 2008. Now, this shot up dramatically in this year because as of 2023, it was still very, very low, like under 10%. And then dramatically, it just shot up. So the bond market, because it's based on the Treasury spread, the bond market is signaling a slowdown, a recession. But you know what else shot up this year, Eric? The equity markets. So I'm looking at this, and either the Fed's wrong in their probability, they're not reading the data right, or the equity markets either don't agree or don't care, or it's interpreting this as good news for some reason, or there's another reason I'm not thinking about. Why?
Okay, so I've received this question a couple of times, as you might imagine. There are a few points that I'd like to make. Is that we often hear that stocks are a leading indicator, or stocks lead the economy, right? And there's a nuance to that because it's not necessarily true, but it's not entirely false either. So the reason, or the way that people arrive at the conclusion that stocks are a leading indicator, and the way that we do it in business cycle analysis, is we look at how often, or what's the average lead time of stocks ahead of business cycle peaks, and then what's the average lead time ahead of business cycle troughs. And what you do, what you notice when you run that analysis is that stocks don't really lead at business cycle peaks. They kind of miss the recession at the beginning and fall quite abruptly. But they do a very good job of picking up the bottom because they bottom early and start to recover. And when you take the average of how they perform at the top and how they perform at the bottom, you end up getting that stocks lead about 1 to 3 months on average. But that average is composed of kind of a lagging indicator at the top and a decently good leading indicator at the bottom. So I think that's important context for people to understand. I would also then suggest that whenever I look in business cycle terms for a turning point in the economy moving from an expansion to a recession or vice versa, I like to do what the National Bureau of Economic Research defines as the 3 Ds. You have to look at the depth, the duration, and the diffusion. So how deep is the change? How widespread is the change across sectors of the economy? And then how long does the change last? If we were to apply that framework to this equity market rally that we've seen in the beginning of the year, you'd give a decent score for magnitude or how much the change has been, because there's been a fairly substantial move up in some parts of the equity market. In terms of duration, you'd give it a decent scorecard as well, because it's been 3 or 4 months. But in terms of diffusion or breadth, you'd give it quite a low score, because there's really been a very significant concentration in 5 or 6 mega cap technology stocks that have driven the whole rally. So if I was to look at the Russell 2000, which is 2,000 smaller cap stocks, that index is actually quite close to its lows, not really that close to its highs. So given the fact that I don't see any significant inflection point in any of the economic indicators that I look at following that whole process, and the fact that the equity market rally is not that broad-based, my interpretation would be that the market is having another of the 5 or 6 bear market rallies that we've had so far, albeit with this one being a little bit stronger and more concentrated in some of the mega cap stocks. The last point that I would really like to make, and this is a tough one for people to appreciate because we're all a little bit short-term in nature, is that business cycles are a process. They're not events. When we think about real estate or we think about the stock market, they tend to move in longer cycles. So there was a peak in the business cycle around 2007. And the equity market didn't bottom until 2009. Real estate didn't bottom until 2011 or even 2012 in some cases. So that's a 3 or 5 year period from peak to trough. So it's very common that after we've had a business cycle peak, that you go through these periods where assets move up and down quite aggressively, even though it's contained within a longer process. One example that I would give you, again, going back to our 07-08 analogy, just for sequencing terms, is that we had very significant banking issues in Q1 of 2008. The equity market then rallied very strongly through the end of Q1 and through Q2, and the S&P 500 was actually within 8% of its all-time high in May of 2008, which was 6 months into the recession. So you could have said at that moment that the equity market was discounting that the worst of the banking crisis was behind us. But in fact, the worst of it was still very much in front of us. And the bulk of the equity market decline didn't happen until the second half of the recession. And then the bulk of the real estate declines didn't happen until after the recession was already over. So while it is difficult to balance the sentiments of asset markets swinging wildly, my view is that within the business cycle, this is still the same business cycle process that's been unfolding for the last 12 to 18 months. We just have to remember that it's a slow process and it impacts different people and different assets at different times, depending on if you, your employment or your asset that you care about falls more within the leading or cyclical economy, or if it falls more within the broader or lagging economy.
So you call this a bear market rally. I'm curious as to why you think that is, and what you would say to somebody who says to you, Eric, I'm going to challenge this view and say this is the beginning of a renewed bull market ever since the beginning of October last year.
Right. So what I would say to that is that again, the participation is low. So I'm not looking just for one index to go up. I'd be looking for a broader basket of them to go up. We're not seeing smaller caps like the Russell 2000 that are showing significant rallies. But more importantly than all of this is that it's not my specialty or my process to use technical or market indicators to determine bull or bear markets. I'm pretty uniquely focused on the actual business cycle, and then using that business cycle as an overlay to think about how asset prices may perform. So I would say that it would be historically uncommon for this to be the beginning of a new bull market, considering the fact that the economy is still decelerating and has not yet experienced the worst of this recessionary process that I think is still unfolding. So if the equity market were to have bottomed in October, but the recession is still in front of us, this would be probably the only time in history that the equity market would have bottomed before the recessionary process started.
Interesting. And so you think
I guess if I could just make one comment, for that statement to be true, and it could be, I don't think it is, but for that statement to be true, you'd have to also be making the case that the economy will not end up going into recession. If the economy does go into recession, which I think it will, and probably already is, then it's going to be unlikely for that to be the start of a fresh new bull market rally.
Okay, so yeah, that was my next question, whether or not you think we already are in a recession. You just said it's possible.
I could maybe elaborate on that because I understand it's perhaps a bold statement. If you'd like to hear a couple of the criteria of how I'm arriving at that.
Absolutely, yeah. Certainly the NBER would disagree with you, or at least maybe they're cooking up something. But anyway, we'll see. Yeah, please let us know what you think.
Yeah, so I actually am using criteria that the NBER outlines. So the NBER is the agency that defines these business cycles. Everyone kind of has a misconception. They are not trying to do this in real time. They on purposely are waiting until all the data comes in, it all gets revised, and they have a very clean picture of what they're looking at. They're for the historical archives. They're not for helping investors with what's coming. So the way that the NBER defines a recession is they look pretty much at 7 indicators that are spread out across income, consumption, production, and employment, your big pillars of the economy. So they're looking at things like real retail sales. They're looking at the labor market, non-farm payrolls. They're looking at personal consumption. They're looking at wages and income, all the big industrial production, all the big economic variables. And what they do is after all of the data comes in, they look at the basket of those 7 indicators and they say, where was the collective peak in all of those indicators? And then where was the collective bottom in all of those indicators? Because industrial production may peak before total consumption. Industrial production may peak before employment. So you have 7 different peaks technically, but where does the cluster of all of them end up peaking out? So when we go through those 7 indicators, we actually have 4 of those 7 that are past peak right now. Our real retail sales peaked in at the end of last year. I think it was actually in Q3 of last year. Our industrial production has peaked. Our real personal income is flat relative to September of last year. And then our 4th indicator, which the NBER uses, is the average of GDP and GDI. They don't just use GDP. So at this moment, 4 of the 7 indicators that the NBER looks at are technically past peak. Now, you do have to have job losses for there to be an official recession, which we haven't had yet. However, if the economy does experience job losses in the second half of this year, and all of the data holds the way it looks right now, the NBER could go back and look at the situation and say a majority of the 7 indicators that we looked at actually peaked around Q4 of 2022. So it is path dependent to make that call. It's predicated on the fact that the labor market will start to lose jobs. If the labor market does not end up losing jobs, then we are not in a recession at the moment. But if the labor market does end up losing jobs in the second half of this year, then when they go back and look at the peak, it's entirely possible that they say the peak in a majority of the indicators was Q4. So it is an asterisk next to that forecast, which is why it's nearly impossible to declare you're in a recession in real time because it is always path dependent.
I got to bring up GDP. I don't know if you've seen this meme from like last year when there was actually 2 quarters of declining real GDP in early 2022, and then there was people were passing around this FINRA test question, like how many quarters of negative GDP do you need for a recession? And like people were like, we don't know anymore because it's supposed to be 2, but we didn't have a recession.
Yeah.
So I'm just curious as to how you're factoring GDP growth because I noticed you haven't mentioned that yet.
Yeah, so it's most countries use the 2 quarters of negative GDP to define a recession. Despite the politics of the situation, I know it's kind of a political world that we live in. The NBER, despite what people think, never used the 2 quarter of negative GDP definition. In fact, on their website, they have a FAQ, a frequently asked questions. And one of the questions is, why don't you use 2 negative quarters of GDP? Which they go on to provide a elaborate response indicating that they use a basket of these 6 or 7 variables, and there's more that goes into it. They do use the average of real GDP and real GDI. Those 2 things, GDP and GDI, are supposed to be exactly the same in concept. So there's no reason why someone would use GDP and not GDI, considering that they seek to measure the exact same thing. At the moment, GDP is positive, but GDI is negative. How do you know which one to use? The NBER averages the 2 of them together. And when you average the 2 of them together, it's actually negative right now. So let's go back to the 2022 contraction in GDP to understand why it's not a good rule. It's a rule of thumb, and like most rules of thumb, it tends to work, 90% of the time, but it doesn't work all the time. So why wasn't the 2022 period a recession, even though we had 2 negative quarters? If we break the GDP report up into, let's say, 3 components, we have what's called our trend component, which is the part of the economy that doesn't really ever move. You think about your spending on education, your spending on healthcare. That's like your services economy. That's your trend economy. Then you have the cyclical economy, which is like your housing, your durable goods sales, some of the stuff that we talked about. And then you have what they call your erratic component or your irregular component. And your irregular component is pretty much the swings in inventory. If you look at GDP over 5 years or over 10 years, changes in inventory end up contributing zero over the long run. It nets out and it balances each other over the long run. But in any given quarter, the changes in inventory can be quite volatile and it could impact the economy. So when we go back and say, why did GDP contract in 2022, was it the trend component, the cyclical component, or that irregular component? It was the irregular component. It was 2 negative quarters of GDP that were driven exclusively, for the most part, by changes in inventory, which were a result of coming out of COVID and the manufacturing and durable goods boom that we had. So, I'm not a political guy, and I'm not trying to take a side here. I am a business cycle guy, and I have to step in when I say that wasn't the recession. The recession is either underway at the moment, but the majority of the declines, specifically the labor market stress, which is really what characterizes the bulk of recessions, that part of it is still very much in front of us.
If it's not already here, the recession, when would you think it's going to come? And no one has a crystal ball, but certainly you've looked into this and maybe your models have shown you a timing.
Right. So the question of when we go to our 7 variables and we say, what's the only part of that equation that's not really recessionary yet, it really is just the labor market. So the labor market will determine, when the broader population realizes or feels the effect of an actual recession. So it's going to be very much labor market dependent. But the problem is that some of these changes in the labor market can actually be lagging indicators. So it's not always a good idea to say, I'm going to wait for the labor market to crack before I prepare for a recession, whether you're a business owner or maybe an investor in some capacity. It has to be some forecast.
Just to be clear, we're waiting for the unemployment rate to go up from layoffs or
that's
firing,
right. So any of your
not voluntary quitting.
Correct. So, you have to see the labor market shake out in terms of like the unemployment rate going up or your jobless claim numbers spiking more dramatically, or just your monthly NFP numbers printing negative numbers.
Because if people are quitting because they've made so much money investing,
exactly.
And, that doesn't count.
So, and I just want to, hammer home the point of that, it is a little bit of a difficult concept that we may or may not be in a recession now, depending on what happens in the future. But that is sort of the way that it works. One example that I want to give to everybody on why it may not be a good idea to wait until the labor market falls apart is because there are recessions of the past where the labor market lags even more so than normal. The best example of that would be the 1974 recession, which was ironically an inflationary recession. The recession began in December of 1973. But the economy didn't experience its first month of job losses until, I believe, August of 1974. So it took 9 months after the recession technically started for the economy to experience job losses. But when it did experience job losses, they were very abrupt. So at the beginning of 1974, the unemployment rate was in the 3s, jobless claims were very low, and the economy was still adding jobs. If we all lived in that moment, there probably would have been a lot of people saying, you can't have a recession because the unemployment rate's too low. And the problem is that the labor market ended up cracking quite late, but retroactively, the recession was already underway. And I think there's some of that going on today because of the inflationary dynamics of this recession, which lends itself to a little bit more of a labor hoarding concept.
Just one more point. I want to move on to the real estate market. Ultimately, does it really matter for people who aren't, I guess, dedicated investors, whether or not we're in a recession or a recession is coming? Ultimately, what people are concerned about is their living standards, which is really a function of their real wages, which is wages adjusted for inflation. And we know that inflation typically comes down during a recession. And so the other variable is their wage. Wages are sticky upwards. Usually you're either laid off, or if you're not, your wages are unlikely, or your salary, if you're a salaried employee, it's unlikely to go down just because we're in a contraction. That usually doesn't happen. And so does it really matter for people? I mean, am I going to get a lower income just because we're going to get a recession, assuming I'm not laid off?
Right. That's a really good question. And what I do whenever I help clients like business owners or individual asset managers, I try and help them contextualize where does their business or where does the asset that they're concerned with or where does their job fall? Does it fall in the leading, cyclical, services? Where in the economy does it fall? Because the answer will totally depend on that question. So, for example, and this is not an exhaustive list, and I'm not trying to pick on anybody. I'm just trying to make examples. If you're a real estate agent, let's say, your income is predicated based on the volume of transactions in the housing market. It's not really based on the price of homes. It's based on how many homes you're able to sell because you get paid based on the transaction volume. So your feeling of a recession is going to come very early because declining housing volumes tend to be a leading indicator. It tends to be in that leading economy. We've already seen the volume of home sales fall 30 or 40%. So anyone whose job or income is based on transaction volumes has already felt recessionary pressure. If you are a construction or manufacturing worker, let's say you build buildings, or you are a truck driver transporting goods from the factory to the retail store, you're in that cyclical economy and you're feeling very significant stress right now because that part of the economy is now starting to shed jobs. As you go more towards the broader economy and you enter the services parts of the economy, which is, to be fair, where 80% of people genuinely are, it's unlikely that that part of the economy feels very significant recessionary pressure until or unless the recession gets extremely severe. So if you have a mild recession, the services economy may not contract at all. And if you're employed in the service sector, you may be employed throughout the whole thing, and you may actually have an advantage because, like you said, your wage will stay the same. The prices of things in the economy will fall and you'll have an increase in your standard of living. But the brunt of these recessions are always felt by people who are employed in the more cyclical industries, which are really tied in my framework to what I call the leading economy and the cyclical economy. So for many people, if you are trying to find out where you fall in this process, if you're in a non-cyclical industry, it may not be as important to you as if you're in the more cyclical sectors. So that's how I would challenge people to think about it. And if you're a business owner trying to maybe do some strategic planning, it's critically important that you understand where does your business fall in the economic cycle sequence. At the risk of rambling on, if you are a non-residential construction company, let's say you build hospitals and bridges and things like this, you are very lagging. So you're not going to experience anything right now. You're probably going to be reporting that your business is booming. But at the same exact moment, if you're in the leading or cyclical economy, you're in the real estate sector based on volumes, you're in the construction sector, the manufacturing sector, or the transportation sector, you're feeling very significant pressure. So that just goes to show you that it's difficult to say the economy is in recession and everyone should be feeling it, because depending on where you are, you're going to feel it at entirely different times.
This leads to the final part of our discussion, which is the real estate market. You talked about it just now. So I'm looking at the Case-Shiller Home Price Index, which is a national index of aggregate of different cities. Now, if you look at it from an annual percentage change basis, it was climbing at 20% per annum just a year ago, and now it's gone down to 0% growth, almost 0% growth. This looks very similar to pre-2008 when the residential real estate market was already rolling over by 2006. We're seeing a very similar pattern. Will this downtrend continue, you think? What is your outlook?
So the downturn in the housing market will continue. And again, I want to separate for everybody the two components of the housing market, which is the volume of transactions and the level of activity, which is a leading economic indicator, and then the price of real estate, which is a lagging economic indicator. If you look at your Case-Shiller home price chart, my guess is that you'll see that the bottoms in all of those price growth come after the recessionary periods. So the bottom in that Case-Shiller price index chart will probably be 2010 or 2011 or something of that nature. So the leading indicators of home price growth are probably all not that surprising. We have to be looking at the availability of money and credit, the affordability issues, as well as the broader business cycle and then the labor market. So when we do put together a basket of leading indicators for the housing market, it's quite clear that we are going to continue on this downward trajectory in the real estate market. Now, I would like to say that the real estate market is incredibly regional. So just like different parts of the economy will feel a recession at different periods, like a real estate agent or a non-residential construction worker, the real estate market will be totally different whether you're living in San Francisco, California, or whether you're living in Miami, Florida. You're going to have two different outlooks on whether you think the real estate market is declining or not. But as a business cycle analyst, I'm more focused in the national statistics and the national averages. So on that basis, we're definitely going to see continued declines in the overall prices of real estate, mainly due to the fact that money and credit is getting tighter, affordability is way down, and labor market conditions are starting to worsen. So it's difficult to have strong upward momentum in prices when those conditions are all in place.
I'm going to point to, some people have commented on strong household formation as perhaps a counter argument to declining home prices. This is a study done by the Joint Center for Housing Studies of Harvard University, and they've shown annual household growth rates. And I'm just going to read a stat here. The American Community Survey, ACS, and American Housing Survey each report that annual household growth between 2019 and 2021 averaged between 2 million and 2.4 million per year. This level of household growth is well above the 1.4 to 1.5 million per year averaged in 2017 and 2019. And so the argument here is that household formation is still strong, in fact, stronger than historical averages. And so it's not really dependent on your income or business cycles. Doesn't matter what your income level is or your outlook on a recession, you still need a home to put a roof over your head. And so demand for houses, for residential houses, will still be strong. How would you respond to that?
So the household formation statistics are in my view, not the best way to gauge the demand for the real estate space because a lot of it depends on the affordability. So just the fact that we saw a huge increase in the volume of home sales when mortgage rates were pushed to 2%, that drove a significant increase in household formation. So when you have a affordability issue like we have now, that's going to drive a decrease in household formation. To me, if you're trying to get a longer term, or what I would call a secular picture for the demand for housing, you want to look at the growth rate of the 25 to 64-year-old population, really the 25 to 54-year-old population, because the consumption of all goods and housing follows a very predictable pattern depending on your age. you consume more housing related expenses when you're in your 25 to 54-year-old bracket. And as you age specifically into your 60s and 70s, your housing consumption drops off of a cliff. So when we look at the growth rate of that population, what a lot of people like to say is that the millennials are bigger than the boomers. Therefore, housing will have a lot of demand. But that's a little bit of fun with statistics. If you have 1,000,000 boomers and you have 1,000,001 millennial, you could say that the millennials are bigger than the boomers. But it's all about the growth rate. It's all about the fact that in 2010 through 2020, for that decade, the 25 to 54-year-old population was growing at about 0.7% per annum. Over the next 15 years, it's only going to grow at 0.2% per annum on average. So there will be demand for housing because you do have an increase in the population that is inclined to consume, but you're going to have less demand than you did in years prior. So in the 70s, 80s, and 90s, this prime age population was growing 2 to 2.5% per year. In the next 15 years, like I mentioned, it's only going to be growing at 0.2% per year. So it's like when you think about a company reporting sales, if you're Netflix and you're gaining subscribers at 1 million subscribers per year, and then 2 million subscribers per year, and then 3 million subscribers per year, and then it trails off to where you're only growing 1 subscriber per year, they would say you're still adding subscribers, but the stock price of Netflix probably wouldn't be too kind to that change in growth rate.
I see what you're saying. And you've talked about population trends. We'll close it off here. You've talked about population trends in one of your latest videos, published actually just this week, why this perfect downtrend won't go away. So summarize this video for us. We'll put a link in the description down below so people can check out your work in more detail. But summarize what you've found so far about the biggest population trend changes in the United States in particular, and what this means ultimately for the economy.
Yeah, thank you. Thanks for mentioning that video. I think it's really important. This is a longer term analysis. Whenever you use population or demographics, you really got to give yourself at least 5 or 10 years because these things don't change and they're very slow moving. But basically what I was trying to articulate in that video was we've experienced this general decline in the level of interest rates and the general level of vibrance in the economy since the 1980s. And a large reason for that, aside from the debt levels, is the fact that the population dynamics are getting worse and worse. Now, as I mentioned in the video, the population dynamics in the United States are not even close to as bad as they are in Europe, Japan, and China, but they're significantly worse than our previous history. So again, you really want to focus on what's the growth rate of the prime age population. What's the growth rate of the population age 25 to 64? Because they do all of the consuming in the economy. And that drives, like we were talking about, more unit volume of retail sales, more production, more employment, and the whole cycle spirals upwards. But as the growth rate of that population starts to decline, like it is in the United States, it gets harder and harder to keep up the levels of consumption that we're used to without relying on artificial demand like increasing debt levels, whether it's consumer credit card debt or the federal government trying to step in and support those levels of consumption. So if we are going to try and continue to support these levels of consumption, which we do not have the demographics to do, it's going to require more and more and more debt, which is going to become increasingly difficult to service at higher interest rates, meaning that that downtrend in interest rates that I articulate in the video will continue. And then the last chart that's quite alarming.
Are you suggesting, Eric, that teenagers in the future can't make a lot of money from cryptos and video games and TikTok and whatever other industry we haven't thought of yet?
Yeah, I don't think so. I don't think that'll be the case.
Okay.
So, But I would encourage everyone to stay into the last chart in the video, which shows the really dramatic difference between what's going on in the US and what's going on abroad. It is really a crisis in terms of demographics for Europe, Japan, and China. It's never before in history where we'll basically watch in real time over the next 2 or 3 decades these major economies lose 20% of their prime age population. It's going to be just an absolutely unbelievable collapse in demand for goods in those economies. And it is unclear how those countries are planning to handle that situation.
I noticed you've sourced the BLS. Yeah, I'll show the chart that you mentioned. You've sourced the BLS in the United Nations. I actually looked at the UN population projection statistics myself, and I've noticed that they include net immigration as well. The underlying assumption here is, yes, the lower birth rates, everything you've discussed, but also that there's going to be more net migrations into the U.S. versus the other countries. Fair assumption, because that's what's happening right now. There's more migrants into the U.S. than people leaving the U.S. Do you think there's going to be anything by 2050 that will reverse that trend? Just speculating here. We're not saying it will happen, but if it were to happen, yeah.
It's really hard to say. I'm not sure. But one thing I would like to mention is that the net migration is a zero-sum game. So if we're obtaining those people from other countries, they're losing them. So on a global basis, we still have the same problem where our major developed nations that drive 80 or 90% of global GDP are all collectively experiencing big declines in their population. So we can't net migrate to all of them. So the US may be the beneficiary of those population trends, which will help us at their expense. Whether we increase immigration or not in the future, I'm not quite sure. I'll leave that to the political pundits.
Fair enough. Eric, excellent analysis. Thank you very much. Where can people learn more from your work besides your channel?
Yeah, thank you so much for mentioning all of that. So you can go to epbresearch.com. I provide various different investor services. And if you're a business owner and you are interested in learning more about maybe where your business fits into this economic cycle sequence and how that may help your strategic planning or business preparations, then we also offer that. And you can just send me an email through my website, which is epbresearch.com.
All right, we'll put a link in that in the description down below as well. I'm just curious, before we close off, why you decided to start your own macro research firm. I mean, you and I have similar backgrounds. So you transitioned from working for other places to, launching your own service. What made you? Yeah,
it's an interesting story. I always had a passion for macroeconomics. I grew up in a household that was centered around finance, and then I studied economics at NYU. And while I was there, I took a course on financial crises, studying all the financial crises that happened all the way back to the tulip bubble. And one of the things that struck me about that course was that every time it happened, it was that nobody saw it coming. So it kind of ignited this passion in me to find out what drives these crises. Why does no one see them coming? So I started to do a lot of my own research and put together some skills that I was learning in other places to develop my own framework and research on how I think business owners and investors can be prepared for these larger economic events, which aren't extremely common, but also aren't really that rare if you think about the course of someone's entire working or investing career.
Fair enough. All right, Eric, thank you again for coming on the show, and I'll speak to you again next time.
Thanks, David. Congrats again on the new show.
Thank you very much. And thank you for watching. Don't forget to subscribe.